Hello, today we are solving May 2019 Unit 1 IAL paper. Abel and Baker were sole traders for many years. Their assets and liabilities in the books are as follows. So let's mark the asset and liabilities. Goodwill is going to be an asset. Okay, it comes under the category of intangible asset. Okay, it's an asset. Then non-current asset will come under the category of asset. It is a tangible asset and it has got monetary values. Here they have also included monetary value for the goodwill. It is an asset. Then inventory is an asset. Trade receivable is an asset. Then trade payables is a liability. It's a current liability. And bank credit represents overdraft. Okay, so for Abel, okay, it is a liability. It will come under the current liability section, and for the Baker it will come under the asset because it is 3000 debit. Okay, so it is an asset for Baker. Now they have given certain adjustments because the new partnership assets were revalued. Okay, on 1st May 2018, when Abel and Baker formed partnership, the books of the new partnership, the assets were revalued. For example, 2000 pounds of trade receivables of Abel were considered irrecoverable, that is, they will be at default. So they were modified as 6500 minus 2000 pounds. That is going to be equal to 4000 pounds, okay, which was considered as not recoverable or irrecoverable. So his trade receivables got reduced to 4500. His asset got reduced. Okay. Now next one is, okay, so immediately you have to write the adjustments there. Okay, when they give, so that you can write the correct figures. So this was 4500. Then you are seeing the inventory of Baker, it was reduced in value by 2500. For Baker, it was no more 15500, it was 15500 minus 2500. Okay, probably these got obsolete or worn out and they were not usable. So the inventory was revalued down to 13,000. So the inventory was valued down to 13,000. Then the goodwill was not to be retained in the books of partnership, and the capital of Abel was to be reduced by 5000 pounds and the capital of Baker was to be reduced by 4000 pounds. So the other factors given here, like interest on capital, salary, interest on drawings, will not affect the capital account. So let's prepare the capital account for Abel and Baker. So these were the adjustment parts, okay, where the books were revalued, and the figures that is going to affect the capital account are going to be marked. First one is the goodwill will not be retained in the books of partnership. Second, the capital of Abel was to be reduced and turned into a loan, 10% loan, and Baker is taking out 4000 pounds out of his capital using check. So this is going to affect capital account and bank account. Okay, probably this was not personal, so it is not reflecting in the drawings. Okay, this was for the purpose of business. So all other factors, okay, remaining factors will not affect the capital account. So let's prepare the capital account. Now, as per the debt click concept, which states all liabilities, income and capital is going to start on the credit side. Okay, the opening balances are going to start on the credit side. So this is an accounting concept you have to learn, so that, okay, you can know where it is going to start from. So liability, income and capital will have their opening balances starting on the credit side. And then, so first one is the asset is equal to capital plus liabilities. We know this. So capital is going to be equal to asset minus liabilities. So let's calculate the opening balance. Okay, opening capital balance for Abel, which is going to be total of his asset minus total of his liabilities. Now the total assets of Able were goodwill, non-current assets, inventory and trade receivables. So the value was, so goodwill was 12,000 pounds and non-current assets were at 14,000 pounds. Inventory was 9,500 pounds. And trade receivables were at 4,500 pounds. So let's add up the whole of the total assets he has. So that is going to be equal to 40,000 pounds. Write all the liabilities he has. Current liabilities are trade payables in the bank. So we can see that the trade payables were at 7,000, okay, plus bank which had become a current liability or an overdraft, okay, so that is going to be equal to 8,000. So the total liabilities are going to be equal to, okay, it is going to be equal to 7,000 plus 8,000, okay, 8,000 from the bank. So that is going to be equal to 15,000 pounds. So now let's calculate the asset minus liability. So that is going to be 40,000 pounds minus 15,000 pounds. So that value is going to be equal to 25,000 pounds. Now calculate the opening capital balance for Baker, okay, from the asset and liabilities given. So for him, bank has also become asset. So the total asset value will be equal to, for him goodwill was 0, okay, valued at 0, and non-current assets, okay, value was around 18,000, plus the inventory, okay, was 13,000, and then you had trade receivables which was at 11,500. Okay, trade receivables it was 11,500 and bank it was 3,000 pounds. So let's add up these, becomes the total asset for Baker, 45,500 pounds. So 45,500 pounds. Now let's calculate the total liabilities. So for him the trade payable was liability and it was around 10,500. So let's write this value. So now let's calculate asset minus liability, 45,500 minus 10,500 pounds. So that is going to be equal to 35,000 pounds. So that is going to be equal to 35,000 pounds. Now let's write these as the opening balances on the credit side on 1st May 2018. So the opening capital balances for Able was 25,000 and for Baker on 1st May it was equal to 35,000. So let's write the opening balances on the credit side. So after filling up, we get on 1st May Able had 25,000 and Baker had 35,000, which we have calculated here. Okay, I'm just writing it here. And then on 1st May 2018, they had other things. Goodwill would not be retained in the books. So goodwill removal has to be done and it will be in the ratio 1:1/3 and Baker 2/3. So the total value of goodwill, even though it is owned only by Able, but the goodwill removal will happen on the debit side and in the ratio given, in the new ratio given. So for the Able it will be 1/3 times 12,000 and for the Baker it will be 2 by 3 times 12,000. So the value is going to be equal to 4,000 for Abel, and for Baker it will be 8,000. So let's write the goodwill removal values. So for the Abel it is 4,000 pounds, and for the Baker it is 8,000 pounds. So for Abel it is, so goodwill removal, okay, it is, for Abel it is 4,000 pounds, and for Baker it is 8,000 pounds. Then it is said that the capital for the Abel will be reduced by 5,000 pounds and it will not be retained, okay, it will be turned into loan. So loan account will get affected and the value is around 5,000. So let's write it here, and the loan, okay, or the capital reduced will happen on the debit side, okay, capital inclusion will happen on the credit side, goodwill inclusion will happen on the credit side, and goodwill removal or capital reductions will happen on the debit side. For Baker, who took out 4,000 through the check, okay, the double entry will be through the bank. So now let's calculate the totals. On either side they have to be the same, so 25,000 on credit side and 35,000 for Baker. Now here let's add on the debit side, so it will be, for Abel it is 9,000 and for Baker it is 12,000. Now the difference in the total balance will be adjusted so that the total balances on either side has to be the same in accounting. So let's write the balance carried down will be equal to 25,000 minus 9,000. So that is going to be equal to 16,000 pounds. So that is written as balance carried down for the month, okay. So and 35,000 minus 12,000, that's going to be equal to 23,000. So let's write it here, okay. For the balance carried down for the Baker, it is going to be equal to 35,000 minus 12,000 difference. So that is going to be equal to 23,000. So now this will be always written as balance carried down will be always written on the opposite side. So that will be balance brought down, okay. If it is on the debit side, you will write balance brought down on the credit side and end it on the 1st May 2018. So on 1st May 2018, the balance brought down, okay. So I will copy it from the debit side to the credit side. So 16,000, and the for the Baker it is going to be 23,000. Now we also adjust the total, okay, on, so that the total is the same on both the